the discussion here in market analysis and strategy, and we're up to niche selection criteria. Now, we've talked about this because we've had a very good discussion on niche analysis. So I won't spend too much time here, but it's just that remember that there are a number of different reasons why you might want to choose one niche or another. And size is one, potential growth is another. How interesting is that niche to a competitor? If this niche is very interesting to a competitor and all indications are that a competitor is going to enter this niche, then maybe we should pick another one. What are the skills and resources required to enter this particular niche? That obviously plays a role. And our ability to defend. If we enter this niche that's profitable for us and we're doing well, but we don't necessarily want others in it, or if they come in it, we want to be sure that we have the ability to defend ourselves in the particular niche. So this is just a couple of reasons why we might want to enter a niche. Barriers to entry, again, these are important things. Again, as I said, there's some overlap here. It's important to understand this when we're doing our analysis of our competitive situation. Are there economies of scale? Experience curve. Experience curve we haven't mentioned before, but it's related to as we gain more experience in the business and in production, we're able to have a significant downward impact on our per unit cost. Product differentiation. Industries that have high degree of product differentiation may be difficult for us to enter, or at least it raises the bar. Capital requirements. Can we get in this business with little or no money, or is it hundreds of millions or billions of dollars to play in this game? And of course, the higher capital requirement, the more difficult it is to enter. Switching costs we've discussed at length. Government policy, government encouraging people to get in. Are there licensing requirements? All of these have an impact on the ease at which a competitor or ourselves can enter the marketplace. Access to distribution and supply channels. Remember what happened to Burger King. There are other examples of that as well. Can we make sure that if we enter this, we have a secure supply of resources? Can we be sure we have a good and open and clear distribution channel? Competitors' reaction depends on. These are a couple of things here, 5 things that a competitor's reaction might depend on. This is the competitor's reaction to a particular entry in the marketplace. Previous aggressiveness. As I said before, the best indicator of how the competitor is going to react if we enter the marketplace is how they've reacted to others. Not guaranteed, but it's a good indication. So how aggressive have they been? Did they just roll over and let them enter, or did they fight? Closeness to supply and distribution channels. If the competitor has strong ties to supply and distribution, they may be less likely to react, or less likely to react aggressively. Willingness to reduce price. Some companies have a policy that they won't reduce price. They're more interested in their margins. And that actually is a good way to be, and we can talk about that another time. But that then potentially opens up the marketplace, the industry, for competitors to come in. If I know that you're not going to lower your price, or you're going to rarely lower your price, I can come in this marketplace with a lower price and perhaps siphon away some market share from you. Product demand velocity. Is demand relatively stable, or does it change a lot? And that may have an impact on how the competitor, who already is in the business, will react. And finally, exit costs. We briefly talked about this in another lecture, but if exit costs are very high, then the competitor is more likely to be aggressive in their response. If they can get out of the business without much worry, or had planned to get out of the business anyway, then their reaction to your entry in the business might not be that high. Entry into the industry, might not be that high. Another part of our competitive analysis, we need to look at the strengths and weaknesses of the products of the companies that we're competing with, of their marketing mix, and of the firm itself. So let's go ahead and talk about those things now. Ultimately, our competitive analysis is about trying to determine some key success factors in this business, ranking those factors, evaluating the competitors with respect to each of those factors, compare the factors, and draw some conclusions. Again, it's very close to any decision-making sort of process, but we are comparing competitors. And we're also comparing those competitors against each other, but we're also comparing the competitors against us. How do we fit? How do we stack up? So, product. Okay. How do we stack up in terms of the product? Product features here. These are also bases upon which we can actually compete. But functionality, reliability, efficiency, ergonomics, aesthetics, legal rights, standardization, transportability, utilization, service. This is not an exhaustive list. You can come up with other ones. But these are things that play a role in determining the features of a product and service as well. Marketing mix. We've talked about the 4 P's: product, price, promotion, place before. We also talked about that oftentimes additional P's are added. Here I've added the 5th P, being people. We're going to dig a little bit deeper in some of these. Product, service, brand. Now, this is a dual-fold sort of thing. One, it's a way we can analyze the competitive situation by looking at a competitor's product and evaluating the brand, level of diversification, the quality, the packaging, the service level, and the market share. At the same time, we need to use this marketing mix analysis to build our marketing mix. We need to have answers, and good answers, for these. What is our brand? What is our product diversification strategy? What is our level of quality? How is our packaging? What is our service level? And what is our market share is going to be 0 from the beginning, but what sort of market share are we anticipating capturing the first year, the second year, the third year? Price. What's the average price in the marketplace? How flexible have the competitors' pricing been? And how do they price new products? Now, we're going to come back a little bit more to talk about pricing strategy in a second, but price is actually very interesting, and it's very troubling to me. It's also troubling in terms of problematic to many entrepreneurs when they're trying to price their products and services, or companies themselves. They don't understand well how to price. They don't understand well how to price. And we'll come back to pricing in a second. Place. Again, place is about distribution. Delivery power. We can think of delivery power in terms of their distribution channels. They have strong distribution channels. Are they able to quickly deliver their product and service quickly? For example, if we take a Zara or an H&M, they have tremendous delivery power. They're able to bring their product to bear through their logistics innovation really quickly through the retail chains. Number of salespeople. The level of sales experience and skills. How efficient is their distribution system? And finally, promotion. Not finally. Promotion is the fourth. We still have one more to go. Advertising, sales promotion, publicity, personal selling. Remember, promotion, broadly speaking, includes all of these things and some other things. It's not just about how we're going to advertise. It's not just about sales promotion, couponing, and those discounting, those sorts of things. It's also about publicity. It's also about personal selling. I mean, if you look at Apple, if you go to an Apple store, these guys are really trained really well, and they sell in a very interesting sort of way. There's a reason why Apple stores have such a huge per square meter or per square yard sales yield. Okay? They sell in an interesting sort of way. They sell in a way that's very effective. Pricing approaches. Yeah, this is the little more in-depth discussion on price. Most companies price their item with respect to cost. They look at their costs and they say, okay, this cost us 100 euros to make. Our typical markup is 200, so we're going to sell it for 300. And that's the way they come up with their price. Well, another way is pricing based on competitive and substitute products. What are the other products out there selling for? Okay, they're selling for around 250 euros. So we'll sell ours for around 250. And now we'll sell ours for 225 because they've been out there for a while. And the third major approach is pricing dependent upon a customer's willing to buy the product on price or by price. You know, what is the customer willing to pay? The value of an item basically is what a customer is willing to pay at any particular time. So what most companies try to do, let's go to the first one based on cost. My cost is 100, so I'm going to sell it for 300. Well, what if customers are only willing to pay these days 200? And I've just gone to the market for 300. How likely are people going to buy my product or service? No matter how good I say it is. You know, that's a really big challenge. That's a really big challenge. So, I mean, what if the market price, what people are willing to pay, is 150, and our cost is 100 plus our distribution costs might take it to 150 itself. So we lose money on every item. The way to think about pricing is understanding what the market is willing to bear at that particular time, and saying, okay, this is the price that we need to come in and sell this product for. And then working on the engineering and development and production side to see how low we can get our costs so that we can make our margins and still offer a product at a price that people are currently willing to pay. That's what you do. You look at what people are buying, and then you need to make it. Now, the question, of course, is, what if you're not able to make it for a cost low enough to make a profit and come in at the right price? Then you have a problem. Okay? Then maybe you shouldn't be in that particular business. Or maybe you need to reevaluate your current value proposition. Maybe you need to reduce the number of benefits that you're offering and coming with a little reduced offering instead of the full-blown offering. And then maybe, based on experience in the marketplace, you can learn, and that will have an impact on your price in terms of you'll be able to reduce your downward pressure on your costs. So at any particular price, you might start making some money. We have some more things to talk about with respect to price, and I'm going to pick those up in the next lecture.